Hello, Market Insights watchers. Well, in Market Roundup this week, US GDP, US business activity, and US new home sales are defying the odds. Find out what's behind these stronger than expected numbers. In tech megatrends, AI in the power sector is growing fast. The number of power sector AI projects doubled from 2022 to the year 2023. Here are two ways to get in on this growing trend. And in Crypto Corner, Ian will give you his latest take and respond to a couple of mailbag questions from fellow Market Insights watchers. And of course, please remember to like and subscribe to this Banyan Hill YouTube channel. We love to have your support, so let's get to it. Well, hello there, Ian. How are you today?
I'm doing well, Amber. Just dodging the cold that's going around. How are you feeling?
Ian, your whole I'm so sorry. Well, I guess zinc and
No, I'm dodging it. I'm
oh,
dodging
you're
it.
dodging it? Okay, cool.
I'm dodging. Yeah, I'm not getting the cold. Every time it comes after me, I'm gonna move out of the way.
I don't blame you.
Yeah.
Let's
I always like, riding the subways in New York City, always with the gloves and the hand sanitizer, and if like somebody's coughing, I'm just like, sorry.
yeah,
But
me
anyway,
too.
hope everyone out there is feeling well.
Yes, yes, I am. I hope you're all hanging in there, everyone. It is cold flu season, RSV, everything. Okay, so Ian and everyone, we saw three strong US economic numbers over the past week. First, US GDP grew 3.3% last quarter, finishing 2023 strong. Inflation cooled also. The Personal Consumption Expenditures Price Index, or PCE deflator, which actually tracks price changes for goods and services purchased by consumers, rose 2% for the second quarter, which is the second quarter in a row and in line with the Fed's target rate. And then as a result, stocks rose on this news, and the prospect of a soft to no landing recession is there. A second, US business activity grew in January by the most in 7 months. Activity was helped by stronger orders, growth from service providers as well as manufacturers who appear more sure-footed about the demand outlook for the US. And as seen in this chart, the S&P Global Flash Composite Output Index advanced 52.3, underpinned by stronger services activity. Readings over 50 indicate expansion. And per Bloomberg, quote, the group's measure of expected output in the coming year climbed to the highest in May of 2022, or since May 2022, boosted by a firmer domestic demand. Chris Williamson, chief business economist at S&P Global Market Intelligence, also shared that, quote, confidence has also been buoyed by hopes of lower inflation in 2024, easing the cost of living squeeze and facilitating the path to lower interest rates, end quote. And third, new U.S. home sales exceeded forecasts on a decline in mortgage rates. Purchases rose 8% to 664,000 annual pace in December, and annual sales picked up in 2023 for the first time in 3 years. New home sales in the Midwest rose the highest level since July, while in the South, purchases increased after falling in November. So there are strong reports for you there, Ian. And of course, we're hoping to see some lower inflation numbers too. So it's pretty cool.
Thank you for that. Do you remember who the Time Person of the Year was last year? Do you remember?
No, I don't, Ian. Why wouldn't I not know that? Tell me. Do you? I know you know because
It
you're.
was Taylor Swift.
Oh, it was Taylor
Yeah,
Swift.
but I'm thinking that Time really blew it. You know why?
Why?
Because it should have been Jerome Powell. I mean, you look at this data right now, and you've got
Wow.
uh, wage growth at 5%,
Mm-hmm.
inflation down to 3%, GDP at 3%. If you add inflation to GDP, you get nominal GDP of 6%.
Yes.
We have not had a time period where wage growth is at 5%, inflation at 3% since the 1990s,
Wow.
Amber. You
Wow.
know? So, the main difference between the 90s and today, though, is that we have a much higher debt to GDP levels in the United States and around the world. That's the main difference.
Right.
But there's a lot of similarities in terms of the technology that is coming, right? In the 90s, you had the advent of the internet. In the 2020s, you have the advent of not only AI, but
Hmm.
electric vehicles and all types of renewable energy that is going to bring the costs of everything down.
True.
And the one sticky part that we're going to have to focus on this decade is debt. And
Mm.
also if the interest rates on that debt goes up, because then debt service costs are going to be very high. We
Right.
have not had to deal with, as a country, especially in the United States, high debt levels and high interest rates, because it means the government is going to need to print more money to
Hmm.
pay that down. But in terms of like where the economy is now compared to what it was, you know, 18 months ago,
Right.
it's just been a remarkable turnaround for Powell. And I do think that even though GDP is at 3%, you have inflation low enough that they still can cut rates this year. They can start what they've been saying, and the market has been forecasting 150 basis point cuts in rates this year, but it's probably going to be 50, 75, maybe kind of ease into uh, the new interest rate cycle. We
Hmm.
we peaked a couple months ago,
Hmm.
and now it's time to start cutting rates. And so far, this has been a very good picture for the economy and also the stock market. And we're seeing it in the data, especially. So, Jerome Powell, kudos to you. Sorry you did not get Time Person of the Year, although, I'm sure millions of the Swiftie fans out there are going to disagree with me on that one.
I would think so. But that's a good point. Yes. Person of the year.
Mhm.
Okay, everyone. So let's turn to tech megatrends. Always exciting things happening there. AI on power grids is an up and coming force that we should all be watching. A new BNEF study shows that AI is, quote, helping utilities maintain, manage, and even decarbonize increasingly complex grids, end quote. So, first, please check out this chart. The number of power sector AI projects doubled from 2022 to 2023. Power sector use of AI reached record levels of activity in 2023. And last year, Bloomberg NEF tracked 91 AI projects in partnerships in the global power sector, projects that included power system operations and maintenance to grid planning and cybersecurity. So this is double the number of such activities in 2022. And AI growth in this sector is seen all over the world, with Asia Pacific, Europe, and the North American region all experiencing an uptick in activity between 2022 and 2023. So AI tech like machine learning, which aims to just imitate the way humans learn, deep learning, which is AI that teaches computers to process data in a way that is inspired by the human brain, and generative AI that can really produce many types of content, including text, images, audio, and synthetic data. They're all being employed by and advanced by the for the electricity grid. So, per BNEF, quote, as the world's power system gets more complex, AI may go from being a nascent innovation to a necessary pillar in utility strategy, end quote.
Mhm.
So, if you like to invest in this overall AI trend, first consider buying shares in the Invesco AI and Next Gen Software ETF. That ticker is IGBT. This ETF is comprised of companies with significant exposure to technologies or products that contribute to future software development. Second, for the specific or a specific stock pick, we're actually recommending an AI stock in the latest issue of Strategic Fortunes. Ian really has his finger on the pulse of AI, and that's not only using AI tech and to help major utility companies like PG&E push forward, but a plethora of other big companies from healthcare to finance. So to get this stock ticker, make sure to subscribe to Strategic Fortunes. You may click the link in the email that accompanies this video or the bull icon right here over my shoulder. And lastly, I have to say this, Ian, is a shameless plug, but if you haven't already heard Market Insight Watchers or haven't done so already, please make sure to sign up to listen in on Banning Hill's biggest event for 2024. It's coming to you in February. Ian and the team have spent I'd say over the past year, working on an AI driven trading strategy that works to send stocks soaring with a 72% accuracy. So to tune into this event, please sign up via the link in the email accompanying this video.
Awesome, Amber. Thanks for the plug. And I just want to reiterate what you said
Mhm.
about AI and the power grid, about how important that is,
Yes.
because it's something that we've written about in the past, the last couple of years.
Mhm.
One of the main issues in this country is a power grid that's 50 years old. A lot of it was built in the 1960s and it's decaying. And, we've seen over the last few years, whether it's been brownouts in states or blackouts in like in California during the wildfires,
Right.
this grid is going to need some serious updating.
Mhm.
And, being able to make it more efficient with the use of AI, I think is going to be a true benefit for that. And that power grid. The other thing is like we're just going to keep needing more and more energy because
Yes.
with the dawn of electric vehicles, you're going to need more electricity.
Mhm.
And then on top of that, Amber,
Mhm.
you know, AI, generative AI is extremely power intensive. I
Yes,
mean,
it is.
we're talking about the system using like 5% of US power by 2030 to
Mm.
have generative AI, and it could even be higher, depending on how quickly, we get to higher levels of artificial general intelligence.
Right.
Um, and so I think that, there's a lot of opportunity in the power space and the grid space to invest
Mhm.
because this trend is just going to keep rolling this decade. So I'm glad you're able to highlight that.
Oh,
Thank you.
my pleasure. I'm glad to do so.
Mhm.
Okay, Ian, I'm all ears. We're all ears on crypto. What's happening in Crypto Corner this week?
Well, first, you pulled up a great table this morning
Mhm.
that I want to just take a look at, and I want to show everyone. This is a XBT, which is the symbol for Bitcoin on Bloomberg.
Mhm.
And what you're looking at is the daily price change over the last month. So starting at the bottom, January 1st. And you can see the percent change on the green days means it went up. The red days, obviously, it went down. And if you add all these together, you have a cumulative up total of about 25%, a cumulative down total of about 25%. So Bitcoin in the last month, the first month of the year around the ETF approval has gone up 25% and down 25%. So we're heading into a much more volatile time than we've seen. Now, volatility is not always a bad thing because if you look back at Bitcoin in 2017, when you had that rally from 1,000 to 20,000, you remember that, Amber? Remember that
Mhm.
crazy year when
Crazy. Mhm.
everyone was people were trying to figure out who Satoshi Nakamoto was, and he was on
Wild.
the cover of magazines, this
Mhm.
anonymous guy. Do you remember
Mhm.
they almost found who he was? They found this Japanese engineer and they
Mhm.
chased this guy down, but it really wasn't him.
Mhm.
It wasn't the real Satoshi. He was just like an
Wasn't
engineer named Satoshi Nakamoto.
wow.
Anyway, they still don't know who he is, although I think it might have been Hal Finney. But that we'll save that for a later date. But let me just share my screen here, Amber.
Mhm.
I want to just show everyone the chart of Bitcoin that I've been looking at, something that I shared with the Next Wave crypto viewers this week. And, through October and November, we had this kind of buy the rally, the ETFs are coming. And this is a classic buy the rumor, sell the news. On the actual day the ETF was approved,
Mhm.
the market actually sold off almost to the point where the support line is where that old breakout was. So back in December 1st, we broke out higher and we almost tagged it the other day and now we've bounced. Now, I think this is going to be volatile. I think there's going to be a lot of back and forth here.
Mhm.
But, a couple things. Number one, in that rally that we had in 2017, you had Bitcoin move from 1,000 to 20,000.
Mhm.
During that time period, you had seven pullbacks of 20% or more. Okay, so when Bitcoin moves up, it does not move in a straight line. And if you're looking to buy more crypto or allocate, the time to buy it during these, massive rallies is when you see a sharp pullback when it's down 15 or 20% like it has been from the highs. Now, there were also a couple 30% down rallies in 2017, so that's quite possible as well. But I think that when it comes to crypto, we hit the turning point last summer. The market has moved up from the lows. Now you have the ETF, so it's a real asset class. And what you're going to start hearing about in the next month is what's called the halving cycle, HALVING. And that's when the amount of Bitcoin that's produced on a daily basis gets cut in half. It happens every 4 years, kind of like the Olympics. We'll call it the Bitcoin Olympics. It's a once every 4 year event. So the blockchain, the underlying Bitcoin blockchain, is going to cut the number of rewards per block, which are mined about every 10 minutes, in half. And as it does that, it takes supply out of the market. Now, it might not necessarily, mean that we're going to have an immediate rally, but it has a psychological impact if people think that now this item that everyone in the world can now buy, in an ETF is starting to become scarcer. And I think that is part of the narrative that's going to drive crypto this year. And then you're going to start hearing about Ethereum ETFs and then perhaps Solana ETFs after that. There's a lot of good things happening in crypto. And I just want to leave it one last thing.
Mhm.
I would be more concerned about the sell-off in crypto if the stock market was also selling off, right? Crypto is selling off not because economic conditions are changing, they're actually improving. Economic processes are improving. It's selling off because there's profit taking. If the stock market was also selling off and other risk assets were selling off, then you have to worry. But you look at the stock market and we're at a 52-week all-time high in both the Nasdaq and the S&P 500. So, that to me feels more like rotations. You have people who are selling crypto that they made gains on and moving into technology stocks and other stocks. You'll see at some point they start taking profits in technology stocks and then move back into crypto or other risk assets. So I think that it's a signal, it's a sign that the rally is more than likely not over, because the stock market is also rallying, even though crypto has sold off in the last couple of weeks. It's more about profit taking.
Okay, valid points there, Ian. So we like to pick your brain a little bit. When I say we, I mean a few people in the mailbag that we got this past week.
Okay.
The first is from our lovely Mike and Sheila, our Inner Circle members. I have two questions for you this week. Number one, Ian, this may be getting us into the weeds with this question, but if we are going to digitization of real world assets on a blockchain, then could this also mean that a private company void of scrutiny by the SEC would maybe not go IPO, but would digitize a sale of their company instead? Or am I just confusing myself by thinking this way? Meaning, could a company or business be considered a real world asset? And if yes, then would not the federal government and SEC frown on this happening? Your thoughts?
That's a great question, Mike and Sheila. By the way, two of my favorite readers who always ask very intelligent questions. So, I think that the real world tokenization of assets is a big thing. I mean, you saw Larry Fink, after he's the CEO of BlackRock, after the Bitcoin ETF happened, he goes on CNBC, he said, this is just the start. Real world tokenization of real world assets is next. And when I think about how capitalism works, right? And just the essence of like, what is capitalism? What makes our society more efficient? What leads to greater prosperity? It's all about the idea of capital formation, right? Somebody can provide a good to the market better than someone else. And in order to grow whatever that business or whatever they're creating, they can raise capital. And throughout history, it has become easier and easier for somebody with an idea, or a product to raise capital. And just in the last couple decades, Amber, we've seen the advent of basically direct to consumer goods. Okay. These are companies that somebody starts in their living room, it might be a new pair of shoes or a shirt, and they're able to raise capital online through some crowdsource, and they advertise, on Facebook or social media, and they can grow a business.
Right.
And they can compete against the large, clothing companies like Nike or I don't know, Converse, Reebok. I don't know what else is out there anymore, Amber. But you see what I'm saying? Like, it's easier to raise capital. And what crypto is going to do, it actually allows you to even more easier, because if you provide a token that's registered to the blockchain, you don't need like a bank or a holding company or anything like that behind it. Somebody who's in the Philippines can invest in a tokenized real world asset project, in Canada. And this can happen across borders, and with people who have no economic history. So this is a dawn of a new type of capitalism where, selling products around the globe is global, but raising capital always happens like in the jurisdiction that you're in. Now, anyone with an idea can go raise a token project. And I just want to say one more thing. When it comes to like a company going public now in the United States, there are certain restrictions on selling equity in your company to other people, right?
Mhm.
You have to go through the whole IPO process. You have to file an S1. You have to, do a roadshow with investors. There needs to be new legislation that basically allows anyone with an idea, with some proper safeguards in place, to be able to finance that idea in like a crowdfunded way without needing a bank or anybody else that's going to take some type of fees away from it. So that's why I think this whole real world asset tokenization, and the other part of that too, is that we're going to be able to provide more liquidity for ideas, okay? And not just ideas, but real world properties. So, something like I met with these guys like 6 years ago in New York,
Mhm.
and they tokenized the St. Regis in Aspen, which is
Mhm.
it's a fancy hotel in Aspen.
Mhm.
I've never been there. They didn't invite me to stay there. They just want
Okay.
to talk to other. So they sold 20% of the hotel in a token
Mhm.
project, right?
Okay.
And the idea was that he said, well, I could have an investor in China who's never been to Aspen
Mhm.
that knows this is basically a luxury good, that can have an equity share it, and then they could sell that token to someone else down the road, and we don't need this whole idea of a bank controlling like the actual piece of property title and everything like that. It just makes the process so much smoother.
Hmm.
And at that point, when I heard that, I was like, okay, eventually, like everything is going to be tokenized on the blockchain, and there's going to be liquidity for everything. But
Mhm.
we also see the price of assets go up if there becomes more liquidity, because one of the hindrance to a lot of real world assets is like the people who are buying them. It's not as easy to sell, right? Let's say you buy a piece of commercial real estate. You buy something at the offer. If you want to go around home and sell that tomorrow, you're probably selling at a 20% discount plus like all the broker fees involved. So I think that tokenization is really going to change the entire financial landscape, both in the terms of like capital formation and also providing more liquidity for any real world asset, not only in the local or like a nationwide,
Mhm.
but anyone out in the world that wants to have some type of exposure to that real world asset. And so I'm bullish on real world asset tokenization. That there are a number of crypto plays, and I know we're working on a couple of them for our subscribers as well. So please stay tuned.
Yes, stay tuned for that.
Mhm.
Okay, Ian, are you up for the second part question from Mike and Sheila?
Sure.
Okay. So
Oh,
Mike
if,
Sheila says,
if I haven't sent everybody away with that
I
little
know it's
long-winded
okay.
answer.
Um,
Okay.
la- um, Mike says, last market insights, you felt that 10-year treasury notes would stay about where it is throughout 2024. Would this then hold down the growth stocks that need cheaper money to grow? We are asking this because we own a lot of
Mhm.
growth stocks.
Well, don't go all in on one specific sector. And
Mm.
and I would say, like, when you look at your portfolio and you want to have some balance in there, you want to have some bonds, you want to have some value stocks, some blue chips, some growth stocks, some crypto. And we've talked about kind of the pyramid.
Right.
And what I like to do, Amber, is like, if I have an allocation to, let's say, technology stocks,
Hmm.
and it has a year like it does last year where like the Magnificent Seven, whatever, goes up 50%. Well, you want to reduce that allocation and get back to like what your allocation was started with. It's same
Hmm.
with crypto. If you had like a 5% allocation to crypto, you know, and now it's 15% of your portfolio, you have to reduce your exposure, and think about either doing this like quarterly or every half year, or in times like in early January where it's like crypto just, it was just, it felt like it was going straight up, and everybody made, a lot of money buying Solana and Bitcoin and whatever. So, that's the first thing I would say. Then you don't have to worry too much about interest rates, right? But what are my forecasts for the year? Well, I think that interest rates are probably going to stay between 4 and 5%.
Hmm.
It feels like the economy at some point is going to slow a little bit. I don't think we're going to have a recession. It doesn't look like it right now.
Hmm.
Um, and growth stocks do better in lower interest rate environments because a lot of them aren't making money right now. And you have to discount future cash flows at a higher rate when rates are higher. You discount future cash flows at lower rates when rates go lower. And that's why we've seen a lot of, a big rally in growth. When it comes to like the big mega cap tech companies, I don't think this really applies because they like Apple, for instance, brings in more cash like in the quarter than like half of the S&P 500 combined. On top of that, a lot of them, what they did when rates were like when 10-year rate was like a 1% is they all did like a bunch of 10 and 30-year like bond offerings and borrowed a bunch of money from investors. And so it doesn't matter because they're not going to have to do any debt offerings when rates are 5-6%, right? So they're kind of like they've already hedged their exposure, the larger ones especially. The smaller ones I would be a little more concerned about, but I do think that like what we saw last year with the Mag 7 growth starts to filter into the medium, mid cap, and small cap tech.
Right.
And you can also make a great case for small cap stocks right now in general, where the ratio of their valuation is the cheapest it's been in about 20 years to large cap. And so I think that means like we're going to see another continued rally in small cap, especially this year, as you start to see some stability in the large mega caps.
Okay, beautiful, Ian.
But thanks for the question, Mike and Sheila.
Yes, thank you, Mike and Sheila. And I want to say, Ian, there was one other question from Tracy B. Tracy B, thank you for writing in. I think you just answered it, but Tracy just wanted to know, do you think any correction in the market for 2024? So I believe you touched.
It's typical, Amber. You have like 5% pullbacks every year during a
Right.
bull market. So that's typical. I mean, the thing that I would really watch out for is kind of like we've had a lot of black swan events lately.
True.
The last couple, I'm thinking like in 2018, we had the taper tantrum. Remember that? It sent tech stocks down 20%. 2020, we had COVID. So in March, the S&P 500 lost 35%. I don't think we'll see one of those crashes unless we have, like a nuclear war breakout like in Pakistan or something like that. Then you also had inflation going to 9%, which everyone panicked on in the summer of 2022.
Right.
So like it's like every other year, and then of course Russia invading Ukraine. So it's one of those things where you just got to be vigilant about some type of risk, unforeseen risk.
Right.
That's what causes the biggest crashes, right? It's the unknown unknowns. It's the ones that like nobody even forecasted coming is what really like COVID is a great example of this. Like it's a snake bat virus in like a Wuhan market, like that became like a global pandemic, right? Like no Wall Street strategists had that on their possible expectation calendar in 2020. So it's just those are the risks that we got to look into. And if you're worried about the market, you know, uh, stock market insurance is cheap. Like buy a put, buy something in December, downside S&P 500 put, maybe put 2% of your portfolio into it. And if the market drops like 20%, the put will pay you back. I don't want to recommend anything specifically, but if you are worried about the market selling off at this point this year, I would just put 2%, of your portfolio into some type of put transaction that, you only lose 2% if the market doesn't crash. But let's say we drop 20%, it'll give you, a nice hedge against that type of crash. Buying puts is always great. You know why, Amber?
Tell me.
Because, well, the way that options price, buying calls is just a bad, it's like a bad bet, because as the market goes up, and you have a call option, the premium in that comes down because as the market rallies, volatility typically subsides.
Right.
As the market sells off, if you have a put option, you're not only winning on the direction of the market, you're also winning because the volatility is expanding, which